News section, main topic, the coin sector. Today is going to be about decentralized storage. And we're going to have the trading zone, trading segment with Robbie. So things that are coming up. Next week is going to be more of a discussion type meeting. We're going to talk about different points in history about Bitcoin, so some sort of like controversial issues, see where people stand on that, and learn more about both sides of different contentious or controversial issues. The week after that, we are going to have a Ethereum smart contract development workshop partnered with the Software Engineering Club. So that's going to be on Monday, the 19th. And we won't have our normal meeting on Wednesday, the 21st. We won't be holding a normal meeting. So don't show up here. I'll probably be here just because in case anybody else shows up, we can talk. But there won't be an actual meeting. So that's sort of what's coming up. Yeah. Yes. It should also be on our website. Yeah, all the info is on our website. If you go to gatorbitcoinclub.com, all the info is going to be there as well. Yeah, that also, if you had an issue joining the Facebook previously, we kind of had to move over to a new Facebook group. So if you're not in the new Facebook group because Facebook's stupid and won't let you move out of UFL designated emails space or whatever, it's really a pain in the ass. So we had to move over. So if you're not in that Facebook group and you use Facebook, then go ahead and join that new Facebook group. So without further ado, I'll give it to Noah, who's going to go over the news. Perfect. Okay.
Okay. Just to go over a little bit that's been going on in this space. Good? Yeah. All right, cool. Okay, so probably the most important thing, if you've been keeping up or if you haven't been keeping up, the most important thing that's happened is the SEC and CFTC hearing that was held about blockchain, Bitcoin, and all like the ICOs and stuff. Basically, what happened was they discussed the potential about Bitcoin or blockchain and like how their feelings or how the SEC and CFTC plans to approach regulations and such. First of all, the meeting was overall pretty bullish if you're a crypto investor. They talked about a lot of good things, and they talked about how they're going to try to implement the same policy they did with the internet, the whole do not harm policy, where they kind of let it grow by itself. They don't try to regulate it as much as they think they should to harm its value, basically. They also added, though, that there needs to be a little bit more regulation, not to the point where it's destroyed, but to the point where fraud and manipulation is kind of rendered useless. Because right now, the whole thing about ICOs and stuff, there's still a lot of scams out there, and they basically just want to protect the American person from all those stuff.
Yeah, I think that's a pretty bad short term for ICOs. Probably maybe get into, maybe not, I don't know. But it's ultimately it's a good thing that like money buying for it.
Exactly. Yeah. Same here. Yeah, it shows a lot of growth in the long run. People like maybe like older investors who are more scared about the whole regulation and how it's not. It's kind of like its own thing right now. It shows that the SEC and the CFTC are really looking toward to the progress of it. And with them coming into the page, you have more things like ETFs on the way potentially. I'm pretty sure they even mentioned ETFs that it's not right now. Maybe it's not. Not in like the near future, but potentially in the long run, we could see it happen. Further on, let's see here. We also have some news from major banks. Somewhat bad for Bitcoin in a way. They're starting to ban Bitcoin or the purchase of Bitcoin from credit cards. So on Friday, I'm pretty sure it was Bank of America that blocked cryptocurrency purchases. So basically, it's for and along with Bank of America, all 5 major banks, including J.P. Morgan, Citigroup, and Capital One and Discover, all banned Bitcoin or halted the purchase of Bitcoin. And it's basically just to protect them and you from, overdoing it, because as you can tell, there's been a lot of FOMO, or a lot of people buying at the tops like 17,000, 18,000, and with the crash, they obviously can't pay back their credit if they bought it that high, so they might not ever be able to pay it, or they might be in the near or long future. So it's for their own protection and your protection, as they quoted. Further on, China also has some news with Bitcoin. They put up their so-called Great Firewall ban on foreign Bitcoin exchanges. Reportedly, they blocked anyone trying to access any foreign exchanges or trading services, and so they have like this big old software or firewall that prevents anything. Everything is blocked, and all advertisements on cryptocurrencies or ICOs are also banned or blocked from showing up on any kind of website. And also, I'm sure if you know about crypto, the market is pretty down from 19,000. It's crashed over 60%, but we saw positive today. It bounced from 6,100 to around 8,000 right now. I think it's trading around. So maybe we got some good looks ahead. Exactly. And that's all for today. Well, I can't offer any. Well, it's not financial advice, but personally, I've been holding Bitcoin for the longest. I held throughout the whole crash from 19,000. So I hope it's a good time. I haven't really looked at any TA on it, but I'm in it for the long run, so I haven't really sold. I mean, if you're looking to get into it, then surely 6,000 is a lot better than 15 or 16 or 17,000. So do your own research and check everything. But if 6,000 is a price that a lot of people dreamed of back when it was at 18,000. So your call. Yeah. On February 5th, they did ban it so you can't make any credit card purchases with Bitcoin. Debit cards or wire transfers still work, but maybe I an article that said it banned it, but that may be the case. Okay.
So yeah, let's just pass it off to Jacob, and he'll talk about the technical developments. And if this is really technical questions, you can sign into Slido or Slido, however you pronounce that, and put in that code, and you can just type the questions, and I'll ask. But I'll just talk about if you want to. Type it in the Slido and we'll address it.
All right. Today I'll be basically talking about current proposals to upgrade Bitcoin and essentially past upgrades to the Bitcoin protocol. Essentially the biggest problem facing Bitcoin today is scaling. Scaling is essentially how many transactions the network can process in any given time. There are the biggest two debates going on right now, or sides to the debate, are should scaling occur on chain or should it occur off chain? The people who are proponents of on-chain scaling are in favor of essentially empowering users. They want to keep Bitcoin intact in a way that transactions occur on the blockchain at all times. And on-chain scaling is any protocol change that improves the network's capacity on the blockchain level. For off-chain proponents, they want to onboard as many users as possible. They want to get as many users on Bitcoin at the lowest fees possible. And off-chain improvements are improvements that don't touch the blockchain, but build additional layers on top of it. All right, so first we're going to be looking at the major 3 on-chain developments. The first is a block size increase, which is essentially just that, an increase to the maximum amount of transactions that each block can fit. The pros of this are you get more transactions per section and lower fees. But a major con is centralization, in that full nodes will require more space and essentially cost to operate, because the blockchain is growing at essentially double the rate if we double the block size to 2 megabytes. And a block size increase is a band-aid solution, in that you can never scale the block size enough so that it will fit the amount of transactions that people will eventually be using. Like, if Bitcoin were to have the same transaction throughput as Visa, which is about 20,000 transactions per second, the block size would have to be like 13 gigabytes per block, which is just unsustainable. Another big con of a block size increase is it requires a hard fork, which can potentially be contentious, which we saw in the case of Bitcoin Cash back in August that caused a chain split in the network. So these are just all things that a block size increase essentially entails. Next up, we have Segwit, which was implemented back in August, which was a cause of the hard fork, essentially, which essentially allowed an increase in block size without a hard fork, because it separates witness data, which are signatures, from the rest of the transaction, which allows more space per block. So essentially, if every single transaction in a block was a Segwit transaction, we would have a 2 megabyte block size. Segwit replaced the traditional block with a block weighting system, in which instead of each block being allocated a megabyte, each block is allocated 4 million weight units. 1 byte of a non-Segwit transaction is 4 weight units, while for Segwit it's only 1 weight unit. So a Segwit transaction will take up a quarter of the space in each block, and in essence have a quarter of the fee. Segwit was implemented through a soft fork, which still allows people who did not want to upgrade to Segwit to send to Segwit addresses and vice versa. And one of the major things that Segwit brings to Bitcoin is it allows for layer 2 upgrades like atomic swaps and Lightning Network, which was a major reason why proponents of Bitcoin Cash did not want Segwit to be implemented, because they were huge proponents of on-chain scaling. Yes.
What do you mean by
actually, I'll be explaining here. On the left, we have essentially a transaction, a non-Segwit transaction. As you can see, the signature takes up over half of the space in the transaction. And on the right, we have a Segwit transaction, which takes the witness data or signatures and separates it from the rest of the transaction. So in essence, we are segregating the witness data, which frees up almost half the space in each transaction. Is that good?
Yeah.
Okay.
Also, you said that Segwit was the cause of the hard fork.
Indirectly.
What is
A hard fork is when okay, let me think about how to phrase this. A hard fork is when a certain, in each block, when you're signaling, well, yeah, it's like Bitcoin. Bitcoin has 1 megabyte blocks. Bitcoin Cash wanted to have 8 megabyte blocks. So they started sending out 8 megabyte blocks, which the Bitcoin network rejected, but those running the Bitcoin Cash protocol were able to use. So essentially it split the network. It essentially caused a split of the network.
So because they increased the block size,
it caused a
rules that were
yes.
before,
Correct.
So that's
Ken? Confirmed. What do you mean by that? It's still contained within the block, but it's not counted towards the block size. It's taken out of the block. Like here, hold on, let me go back real quick. So each Bitcoin block is still 1 megabyte of transaction data, but it could be 2 megabytes if every single transaction is Segwit, because the signatures are not considered part of the transaction. Yes.
A good analogy for it could possibly be every transaction is a line on paper, and if you just cut half of that line out and put it on the back, it won't count towards the front count, but it's still.
That's a good analogy. So it's still contained within the block. It just doesn't count towards the block size. Essentially, it's still there. Yeah, it's. It's still saved on the blockchain. It's still saved on the blockchain. It just doesn't count towards the block size. Like, I'm trying to think of a better way to explain it. It's like.
So like from what I understand, months ago, so I met so many people, but what I remember is Segwit is back to its legacy.
Yes, because it's a soft fork.
Those who or two so that'd be defined as Segwit. So if you're a legacy node, you still confirm all of the non-witness data. But if you're a Segwit node, then you still confirm all of the data, which includes the witness. And thus, you would ultimately have larger blocks and a larger saving.
Okay, yeah, I see what you mean. Okay, so you're saying that if a Segwit node has bigger blocks,
Correct.
Which it does, but it's not a block size increase because it doesn't change. Okay, if you go through the Bitcoin code, it still says max block size 1 megabyte, but this is essentially a loophole in that they allow a block size of up to 2 megabytes by essentially not counting the witness data towards the overall block size. So essentially, imagine the transactions on the left. Let's say hypothetically there were 20 kilobytes, but the signature took up 50% of that. So the signature essentially takes up 10 kilobytes of that. On this side, that same transaction, that 20 kilobyte transaction, would only register on the node as 10 kilobytes because it's not counting the rest of the signature towards the overall block size. No, it's saved, but it's not counted because they use. Okay. The node to save it. No, it's all saved the same way. It's just not because it's a block size increase without a hard fork. That's essentially what Segwit is. I'm sorry, I just can't explain. No. Okay. Oh yeah. All right. Lastly, another on-chain proposal for scaling is, I'm pretty sure it's pronounced Schnorr signatures, which essentially allow transactions from multiple addresses to use the same signature if all the transactions are being sent to the same address. And that essentially means one signature per transaction. So this allows essentially native multi-sig, which is, I'll get into that later, but it reduces storage and bandwidth by 25% because of the large amount of data that signatures require. And one of the big pluses of Schnorr signatures is that it reduces spam attacks because of the fact that it decreases the amount of data being sent per block or per transaction. Most spam transactions or spam attacks are essentially propagated through the use of large amount of signatures per transaction because they take up so much data and fill up the block so much. And having one signature per transaction will leave more space in each block, therefore making it more expensive for spammers to fill those blocks. As you see on the left, currently, if you're sending from multiple addresses to one source, you require a unique signature per transaction or from each address. But through Schnorr signatures, you require just one overall signature for the overall transaction. This is a big plus because one thing that's being advocated in Bitcoin is to not reuse addresses, mainly for privacy purposes, because it's all public. You can see what amount of Bitcoin in any address. So the introduction of these types of signatures will allow that privacy essentially to still be used by an everyday user, but cut down on the load that is causing on the blockchain. Okay, so this is an example of how signatures are used in spam attacks. This is just one transaction out of 16 that were contained in this block. Usually there are about like 3 or 4 signatures, but in this case, as you can see, there are a lot of signatures. So this filled up blocks a lot. So the introduction of Schnorr signatures would reduce all of these signatures to just one, which would fill up a ton of space in blocks. They're used to verify that the person that is sending the Bitcoin is the person that they say they are. Like those signatures are from private keys, so they verify the authenticity of the person that's sending the Bitcoin. All right, next we're gonna move on to off-chain scaling. First up, we got atomic swaps, which is huge in my opinion. They allow for the exchange of cryptocurrencies without a trusted third party or a centralized exchange. They use things called hash lock time contracts, which is a form of a smart contract in that, let's say I want to send Bitcoin to someone in exchange for Litecoin through atomic swaps. I will create a hash lock time contract. I'll send my Bitcoin to essentially a multi-sig address. And if I don't acknowledge receipt of the Litecoin, then the transaction will cancel and I'll get my Bitcoin refunded. So essentially it keeps both parties honest in this transaction so that one person can't just run away with the other person's funds. Yes.
So essentially both have to take whatever amount they put on that contract.
Mm-hmm.
And then the second both are incorrect. If one person receives and the other it automatically does this.
Yes. But like, let's say hypothetically, I send the Bitcoin to the contract and they don't send me the Litecoin, then I can cancel the contract and I get my Bitcoin back. And then currently atomic swaps have been completed between Bitcoin, Litecoin, Vertcoin, and Decred. And a big thing that atomic swaps allow is the spending of these altcoins or atomic swap compatible altcoins at Bitcoin only merchants. So I could be spending Decred at a merchant that only accepts Bitcoin and atomic swap it like that. So I'm having to go sell my Decred on like Bittrex or Binance and then send that Bitcoin. Yeah.
So if I were to trade Bitcoin on it with a blockchain, how does it work exactly?
Like the
correct. If I am supposed to be Bitcoin, I need to have a Bitcoin wallet, or does my wallet or the wallet accept all?
There are wallets that accept all kinds of coins. Usually merchants only accept Bitcoin at this point in time. So yeah, can you rephrase your question? I mean,
if one person only accepts Bitcoin,
yeah,
only has the Bitcoin, another person is trying to use altcoin, but the atomic swap is used to do a transaction. How does the Bitcoin only person receive Bitcoin? Assuming they don't have a wallet that might have a
So I will send the Vertcoin to an atomic swap wallet or a decentralized exchange in a sense, and there could be some random person who wants to buy my Vertcoin with their Bitcoin, and I'll swap my Vertcoin for their Bitcoin, some like random person. It doesn't matter. And then I'll get their Bitcoin and then send it to the new person's wallet. It's a decentralized exchange in a sense. Yeah. Mm-hmm. Yeah.
Is there any conversion for the person swapping it with the atomic swap wallet? Or is there similar to like a miner's fee?
No.
Have something in there that they would get reimbursed for nothing?
You mean the person, people creating the wallets, or? Yeah, it's just like any other wallet. Just, peer-to-peer. All right. Next up, we have Lightning Network, which is a layer 2 protocol that allows for trustless, near zero fee instant transactions. And they do this using bidirectional payment channels, which are just bidirectional. They're payment channels that allow the sending of funds to and from. Lightning Network only broadcasts transactions to the blockchain when you open and close these channels. So if I want to send Bitcoin to someone on the Lightning Network, I open a channel to them. Once I open a channel to the person, I can send as much Bitcoin to and from with almost no fee as I want, and I only pay fees when I open the channel and when I close the channel. And because of this, Lightning Network is immensely scalable, millions or billions of transactions per second. And a good analogy, in my opinion, is that Lightning Network is to the blockchain as the World Wide Web is to the internet. The internet is essentially just the infrastructure, is the connection of computers, and the World Wide Web made that connection usable to the average person. And this diagram essentially illustrates a basic Lightning Network transaction in that Alice wants to pay Carol, but she doesn't have a channel open to Carol. So she pays Bob, and then Bob pays Carol. So essentially, it's like a routing network. It's similar to that in you don't know the IP addresses, or you don't have direct connections to all the IP addresses of the computers you want to contact, but your ISP does, essentially. So you send your packets to the ISP or your data to the ISP, and your ISP sends it to wherever you wanted to send it to originally. Okay. Yes.
So, like online, I'm hearing a lot about it in a second. Is that like they're setting up channels?
Yes. Bob would be a node in this instance because he is like the intermediary. Oh, yeah. Layer 2, it's because it's essentially, it's more, it's just a phrase, honestly. Like blockchain is layer 1, and then Lightning Network is built on top, like layer 2.
So when you can, so when you open a channel and close a channel, that gets resolved on the blockchain.
Yes.
Okay.
You always have the
Transactions that happen in this way.
are on the Lightning Network. Yeah. All right. On the left is a diagram of essentially the internet, all the connections, and you can see how there's a lot of like dense areas in both sides. The right is the Lightning Network. And this is honestly one of the only, in my opinion, downsides of the Lightning Network is that it can lead to internet service provider like entities, which leads to centralization of the network. Last up, we have side chains, which are essentially just extra blockchains attached to the Bitcoin blockchain for feature implementation or micropayments in general. And all these do not affect the blockchain as a whole. So you could have a sidechain for more privacy, or you could have a sidechain for an upgrade that you want to do, but you don't want to implement on the blockchain right now. And they use a two-way peg, which allows a two-way peg. If you want to transfer to a sidechain, you essentially lock your Bitcoin, and then you're given X amount of Bitcoin on the sidechain. So it allows you to essentially just move funds between chains. I think that's it. Yeah. Questions?
So the side chains, they're like separate blockchains
That are attached to the network, so that they're essentially one use case of sidechains is that they offload some of the as if the network's congested, they can offload onto a sidechain to relieve congestion. Theoretically right now, it's really only being used for feature implementation or things that cannot be implemented on the blockchain, or that are not ready to be implemented on the blockchain, but can still be used on the main net.
know that people say like that's a way to get around Bitcoin. You can just
Yeah.
So with this sort of you like just using it.
It would be similar. It would be similar. Yeah. A sidechain is still blockchain level, still layer 1. It doesn't use bidirectional payment networks or anything. It's all still blockchains, but it's just blockchains attached to blockchains. Yeah. I'm actually not sure. Now I don't think so, because it is intrinsically attached to the blockchain, because it's not like a separate blockchain. But possibly, I'm also not sure. Yeah. No. You still use Bitcoin on the sidechains, but the sidechains have different protocols or different features than the actual Bitcoin network. It's more like in parallel. Like you have your center, and then you have like it's just attached, like a link. More so, okay. So like, I'm trying to think how to phrase this. You can move Bitcoin between sidechains as much as possible, and each sidechain has different features from Bitcoin, but it's still Bitcoin. So if you want to implement a different feature on Bitcoin, but you don't want to affect the main net, you can implement a sidechain. Okay. Yeah. You can have micropayments, beta features on the Bitcoin network. It's been said that additional privacy features can be added. These are just examples. All these are theoretical. A sidechain hasn't been implemented yet. Yeah, I believe so. Yeah. No. Yeah. Disadvantage? Not necessarily, because they do not affect the main blockchain. I'm actually not sure about that. I wouldn't think so, but I'm not sure.
That question is, since there are options to do blockchain, so any node information that is part of all there, and you can there that might have actual like exchange value, like let's say in a privacy network, there's like accounts or two accounts that don't want a system to like recognize that their accounts. Then they could probably go into a sidechain, exchange money, and then the node could pick up that money was exchanged. But all that it would see is that sidechain A had this exchange between two accounts. It wouldn't have like a public account number or hash to it. That's how I would assume.
Yeah. Yeah. Sidechains are very similar to atomic swaps, but the main difference is that sidechains are still Bitcoin. It's essentially swapping for coins that are still Bitcoin but have different features. Yes.
A different kind of question. Would you think sidechains would render certain, like if you have this protocol that's built on top of Bitcoin itself, would it render some of these other altcoins that are trying to take, that protocol and put a different coin's name on it and brand it as something else? If Bitcoin ends up, establishing these protocols, would it just render all these other coins useless, or
I mean,
like counterparty, or like some of the things that are trying to do, things with the Bitcoin, protocol, but not if Bitcoin Core implements it and not these other altcoins, they're not going to use the altcoins. Would they just use Bitcoin, or is there some way they could do it?
I mean, they could link through atomic swaps, but in this case, you still have. There are two sides of the same coin, in my opinion, in that you can still use the main bonus of sidechains is that it's still Bitcoin. So if you're taking a coin, it might if you have like Litecoin, like the main feature of Litecoin is that it's less congested than Bitcoin and that it has faster transactions. But if you have a sidechain built onto Bitcoin that has all those same features, it'll, in my opinion, render Litecoin obsolete because it's much easier to just move coins to a sidechain than to convert to an altcoin. The biggest one right now is Liquid. It's a Blockstream sidechain. You can look it up. I think it's very close or almost near completion. Liquid, it's a sidechain for Bitcoin. It's theoretical. I'm not sure how close. I'm sure it's close to being completed. I'm pretty sure. Any other questions?
What do they? I don't know if you know. What do they aim to do? Like, are they for micropayments or what kind of sidechain do they?
Do you have it? Yeah. Do you see Liquid on there? Is that for Liquid or? Okay.
So
Yeah.
they would try and brand themselves to a faster method, like transactions to someone like an exchange.
Yeah, it's like offloading Bitcoin load onto a sidechain. Mm-hmm. Funds to and from the sidechain? It's faster because let's say the blockchain is like, okay, I'll use an analogy. You're on the highway is jam-packed, no movement. But if you get off the exit onto the slightly smaller highway, but there's no one on that highway. And then later, further down the road, you get back on the main highway. Do you have a... Yeah. If you think of anything, just talk to me afterwards.
Okay, so now we'll get into the coin sector part. I'm going to talk about decentralized storage, coins that aim to handle the storage problems that blockchains have. So, that Bitcoin has. So in currencies, in Bitcoin and these different cryptocurrencies, there's issues of scaling, like we just heard about, and it's really inefficient to store data on these blockchains. Even though it's possible, it's kind of contrived, and it's really it's even worse to try and put data on the blockchain. So there are different projects that are aiming to better make that efficient and better serve up data as like a cloud solution. And so, so what's the purpose of these decentralized data storage projects? Basically, they want to get rid of the cloud monopolies that are there today, like Amazon, Google, or Dropbox. And all these data centers are central points of failure. And if somebody is going to hack some network like Amazon or is trying to get access to some properties of some data that they have in the cloud, then it's easy for them to know exactly where they have to attack. The attacks are hard, but they're possible. And when that happens, you get these massive data leaks from, if not Amazon, you get it from Target, from Home Depot, things we've seen in the past. And so generally, the way that these projects work is you'll have your file that you want to send out to the network. There's all these algorithms in place to help you do that. And it takes that file, it splits that file up into all of these different chunks. Sometimes the amount of chunks may be different. In some cases, it's 30, whatever. Basically, you split it up, you encrypt it, so only you can read the file, and then it gets distributed out to a bunch of other people in the world. So if you wanted to connect to one of these projects, I could rent out the extra space I have in my laptop to store these files that other people want. And that's basically what all these projects are doing. And a really big important aspect of this is that it's a lot cheaper. You'll see that in some cases it's like $24 or $23 on Amazon to store a terabyte of data. But with these different projects, it could be $2, $3. It really gives a market price for, if you want to rent out your drive, you can rent it out for however much you want. And right now that's about $2 or $3 in some of these projects. So the first coin I want to talk about is Filecoin, and it's also related to Filecoin is IPFS. They're very much linked, but they try to separate the technology behind them. So IPFS was the first thing to come out, and what it aims to do is it tries to replace HTTP. So it's a network like HTTP, but instead of it being you're asking one central server for data, you ask a bunch of different computers that are connected to the network for that same data. And so it's at a lower level than it's at a lower level than some of these other things that we're talking about. And Filecoin builds on top of that. And Filecoin gives the incentivization for people to rent out their space. So IPFS is the technology that is there in place to get and retrieve data from these different computers. But Filecoin lets it be the case that I can rent it out and actually receive payments for renting out my storage. And some interesting things about this project is that it incentivizes people depending on how close you are and how efficient you can serve data. So if I'm storing a part of a file and somebody in Jacksonville they request to view the file that they've stored, since I'm closer in Gainesville than somebody in China, if I'm able to better serve that file to that person, I'll get compensated more Filecoin, or I'll be greater rewarded for being able to do that faster than other people. And something that they use is proof of storage. So there are all these different consensus rules for the state of the network and where these files are being stored. And proof of storage is basically when somebody wants to host files on their hard drives, you're able to, it's a way of saying, okay, I do have this space to store your file, and I can prove it to you by running this algorithm, this challenge that you send me that requires me to have that much space to answer the question. And in that way, you can make sure that people have the storage that they say they have, and that's the purpose of it. So next, I want to talk about SIA and SIA Coin. So a big thing about the big differentiator of Filecoin was the fact that you have IPFS and Filecoin sort of working together, but they're two distinct technologies. With SIA, it's all baked into one. And what you can do, it's the same idea of hosting or renting out space on your hard drive, but it all works through smart contracts. And when I want to go and host my files somewhere, I can set up a smart contract that lets other people decide that lets the hosts that have their storage decide if they want to host the files that you're giving them. So you can change all these different properties about them, like how much I'm going to pay you for storing this data for however long. And in that way, it's more customizable and decentralized because there's nobody in the middle telling you where it's going to go. It's peer-to-peer. You are negotiating with somebody who should be storing the data. And what's interesting about this is the retrieving and loading of data that you put out to the network is done off-chain. And on chain, there's proof of work on the actual contracts themselves. So you put out this contract saying, I'm going to rent space to you, or I'm going to pay for you to store my data. And those are typically like 90 days long, and they auto renew. And those are put on the blockchain, and that the contracts themselves are secured by miners that are incentivized by getting the token. So you use the token to buy and sell, buy and sell storage space, and the issuance of those tokens are done through the proof of work mining that make sure the smart contracts are immutable. So there's the SIA coin that does just that, and then there's this SIA fund where people can purchase. There are only 10,000 of these SIA fund tokens, and if you the holders of SIA fund tokens get 3.9% of the payouts from these smart contracts. What you'll see a lot of in these developing technologies is that the people that are developing them obviously want to profit, and this is just like a new business model that you'll see. The companies that are developing these products want to be able to profit off the work they put in, and I think that personally, I think that's a fair thing to do. So there's the last thing I want to mention about it is that there's an uncapped supply. So there's going to be an infinite supply of SIA coin, but it is only going to be the inflation of SIA coin is only going to be about 2%. So it tails off. Did you have a question? So the reward for mining SIA coin, I don't know if it's reached this point yet, but after a while, after a certain amount of SIA coin have been mined, there's going to be a constant amount of SIA coin that are being released. So it's a way of incentivizing miners to continue securing the network after it's already been mined out, if that makes sense. So there's a concern when Bitcoin is fully mined that there may be like who's incentivized to secure the network. And with this inflation, this constant reward, there's not as much of a concern. Did that answer your question? Okay. And this inflation of 2% that's like the worst case scenario. So there are ideas that are in place for burning SIA coins, and you'll see this a lot as well in these projects where you have this idea of burning for features. So that's just me paying SIA coin to use a feature, and afterwards it's just totally destroyed. Nobody can use it. And in that case, it could be possible that this still would be deflationary if the use of these features for burning outpaces the inflation. So this is the most distributed project that I found. I'm sure there are more projects out there that are that I don't cover today. And if you know of any of them, let me know at the end. And I'm happy to look into it or talk about it. But moving on, we have MadeSafe. So MadeSafe is trying to be more than just decentralized data storage. It's also trying to be what's called like an autonomous data network is what they call their technology. And interesting things about this is that it doesn't actually use a blockchain. So all of these other projects are using blockchain technology because it's been a staple. But what MadeSafe does is it just tracks the previous owner, and it has a unique coin ID for all of the for every coin, and you're able to find out who the owner is just based off of the previous owner and the coin ID. You don't need to have the full transaction history like you do for Bitcoin or other cryptocurrencies. And so the decentralized storage part still works in the same way as the other projects, like I mentioned. you split up the files, and it gets separated, and it gets loaded back later when you ask for it. But something interesting about MadeSafe, what they do is the way that they encrypt files is dependent on the data that you've actually sent. So if multiple people, like everybody wants to listen to Taylor Swift's Hot School, so they put this data onto their decentralized data storage. But if there's a million people putting this out there, we don't need a million copies of the same thing. So what they do is they'll check to see if the data that you've put in is exactly the same as another piece of data that they're already hosting. And if it is, and they will just link you to the one that's already being hosted. And there are an amount of backups to make sure that it's always available to you. I think there's about 32, specifically 32 is a number that they like to use, backups for any particular piece of data. The coin itself, SafeCoin, is distributed through what's called proof of resource. So in this, because they're trying to be so much more than decentralized storage, they're trying to be like lower levels of the internet protocol, like what IPFS is doing. They're trying to put that into place with decentralized storage and other things that are related to computers. So proof of resource is contributing any sort of resource that a computer uses towards the project. That could be hard drive space, that could be computation power, and you be paid, or they call it farming. You'll be farming your SafeCoin, depending on how much effort you put into the network.
When you say that each coin is a unique ID, does that mean not divisible less than?
It actually is divisible, and when you divide it, I believe it's given a new ID. The incentive for the nodes to contribute their resources, they get paid in the coin. No, in SafeCoin, which is the native currency of the application. So if you're going to try and store data or use whatever services they're trying to provide, you're going to have to pay for that in SafeCoin. And that's what theoretically gives it the value. So when you've put enough resources into the network for a long period of time, there's this like ranking that you can have for, there's a ranking of all the nodes. And if you're one of the higher ranked nodes, you can get promoted to one of 4 different purposes, which are all related to how the internet and lower protocol things that they're trying to do. It's all related to getting those goals accomplished. And the way that it maintains its decentralization is, I wrote here, like an internal governance like the US government, but way more decentralized than the US government. You'll have different like heads. So all of these 4 different organizational bodies kind of keep each other in check. And the groups themselves are comprised of 32 members. So they all are incentivized to go along with the right thing unless they think that somebody is going to be, or more than 16 nodes are going to be pushing out incorrect data or fraudulent data. So that's MadeSafe. And lastly, I wanted to talk about storage. And so I used to be a pretty big proponent of storage. And I think they've shifted away from what I originally read about them. But I wanted to mention that it's not actually decentralized. So there's a company out there, Storage Labs, that holds 75% of the token supply. And you also have these bridges, or what they label as, or the term they use is bridges, where people can pay just with credit card they don't have to use the native token to store their data. They just pay it to Storage Labs, and then Storage Labs does all of the networking that it needs to do to make sure that people are actually hosting their data. on individual machines and spread out to individuals. So if you don't trust storage labs to pay you, then don't use storage. I mean, you have to trust they're going to pay you. It's not unlike the companies that we see today. It's just their main spin on it is that they are providing a cheaper solution than what's being offered now. And they have partnerships in place already. FileZilla is a popular file transfer protocol client that people use if they're developing, and they've actually integrated with them, which I thought was a pretty big thing when it happened. And they're going to claim that they're decentralized because at the end of the day, the files are stored on individual computers and it is spread out, but the way that those files are getting stored is centralized. So that's the controversy or the debate around the decentralized aspect of storage. And that's it. That's all I have for these projects. Any questions about any of these projects?
So minus storage, all the ones, what would stop somebody from getting a massive hard drive and becoming one of the biggest storage nodes and then making it central? What would stop somebody from trying to make kind of hardware, being able to store all this data, thus making it central?
Well, I imagine you'd have to have a lot of storage to overcome the network already. But I'm not exactly sure if there are mechanisms in place to prevent one person from having all the access to that data. But I would imagine it's very difficult.
Well, I know for at least Segwit, like the data is stored on multiple machines, so and it's all encrypted. So I mean, if they did have access to that data, they can
Yeah, exactly. That's a really good point. It's all encrypted, so. That they have 75% of their tokens. So what happens is people pay by credit card or fiat to Storage Labs, the company, and they make sure that they can send out the information to all the individual users. And then the way that those users are reimbursed is that Storage Labs manually goes in and says, okay, you get this amount of storage coin. So it's sort of like they're liquidating their position by taking all the fiat that they're getting and giving out storage coin to people. I'm not as big of a fan of storage as I was previously, but that's not to say that it's not a credible project. It's just a centralized one. And it's not unlike the solutions we have today, other than it offers a lower price point. Has anybody heard of a decentralized storage coin that I didn't mention? Okay, all right, perfect. Robbie, you got the trading? Excellent, take it away.
Is it, which one do I put it on? So, oh, never mind, I see it. Mm-hmm. What's up, guys? I'm Robbie. I like to trade. Hey. Okay. Well, so last week I talked a lot about support and resistance, and I kind of felt at the end like I was rambling a little bit. And now I want to talk more about how we can use those supports and resistances to kind of, help us with trading. So we're going to talk about how you can trade the trend. The three things that I'm going to be going over is pattern recognition, the possible Bitcoin trend reversal, and the possible Ethereum trend reversal. So obviously Bitcoin's been crashing. Ethereum kind of held its top for a little bit, but now it's, teetering. Is it going to go back up? Is it going to go down? Also, before I get into any of this, I'm not a financial advisor. So don't take what I say with a grain of salt. Do what you want with it, but it's just knowledge. It's not any advice. The other thing that I want to touch on is something that I like to call it like a price time continuum. So you kind of analyze price pattern. When I talk about pattern recognition, you got to think about price over time. Well, you got to think about price as its own entity and time as its own entity and how they communicate with each other to ultimately give you the price that you can trade over time. These are what I call structures. So before, the supports and resistances measure the entity of the price. Things like fractals, fractional components of a coin that you see resembled in the same coin over time is how you can measure consistency, different market cycles, and trend reversals, different trends over time. These are what I call structures. So you can use these to identify a bigger picture, because all of these structures are made up of individual trends, declines, inclines. So you have to be able to recognize when you can make a trade off of these structures. So I know it's a little bit hard to see here, but here is how you would possibly trade some of these structures. So at the top, we have reversal patterns, where you can see bullish trends start to turn bearish. Head and shoulders is the biggest one that you're going to see repeated, especially in crypto. Let's see, continuation patterns you see in the middle here are going to be where you have a bearish or you have a bullish trend, and you're going to be looking for, maybe you missed that original entry, so maybe you missed that 6K bottom that happened, but you see one of these continuation patterns bullish. You want to make a re-entry, or you want to get in on an original entry and then trade it up that way so that you don't completely miss out. You can use one of these structures and these diagrams that are tried and true, instead of using your emotions and FOMOing in, buying at a price that you don't want to be really buying at in the end. Does anyone have any questions on how you would use some of these structures? I know it's kind of diagrammed there, but it might be hard to see here. Okay. Some examples of structures not in crypto. So these structures they're continuous throughout price and time. So whether that is in a market for cryptocurrency, analyzing social, markets, other financial markets, doesn't matter. What you want to see is these structures that are repeated that, you've been able to analyze in the past. You can repeat trends like this in the future. The strength of a structure, because all these different structures, contribute to different things. You have, let's see, how would you recognize that this bearish trend is going to turn bullish? Well, volume is how you're going to measure a strength of a structure, a strength of a trend. What you need to see on trend reversals is especially high volume. That's to signal that, the sellers, they cascaded into the amount of selling volume that they were going to peak at. That happened. Actually, it happened here. This is the start of a bear trend. You can see that on this wick right here, the amount of sell volume, less than this sell volume, it's a weaker bearish trend now. You had more volume up front, contribute to more downward movement over time. And then you had smaller volume, eventually followed up immediately by a big green volume, more, green volume compared to some of its other volume around it, leading into a break on a bullish trend. Bless you. This is an example of a cup and handle, a very bullish pattern. And this is usually seen by some sort of rounded movement. In crypto, things get kind of jagged because they're so volatile. What's up? Mm-hmm.
What is that volume? Volume being held
That is volume traded. So yeah, the more volume you see is an indication of more strength behind a trend. So if that volume, it's, goes back and forth, fluctuates within a candle, and then that huge sell volume pops up and it shows bearish, that amount of volume, since it was so strong, is going to show you it was a very bearish trend. Yep. Mm-hmm. I think it's a complete parallel. You can use the same exact structures you see in stocks, in other financial markets. You can use all these indicators, all these markets, and transfer them to crypto. I think they all measure trend in some way. You just got to identify the strength of these trends, and then that's what's going to contribute to your trading. Getting there. Yeah. So, yeah, you're right. So what I was saying before is that in crypto, things get a little bit more volatile. That's where I was getting. But although these charts might seem jagged, I mean, you can see this is a pretty clear cup and handle in this market, but it has jagged movement. This isn't something that's staying completely structured and rounded. It does have some volatility to it. The chart on the right is just an example of a bear pennant. It's just a continuation movement. You can see how, the volume here on this bullish movement up, followed up by weaker volume. It kind of shows the same pattern, although weaker, showing that this bull trend is weaker, eventually leading to a bearish movement. Now to translate this into crypto. Yeah. Oh, my fault. Sorry, I didn't see your hand. Yeah. Okay. So I definitely know what you're saying. And I would say it depends personally on you, what kind of trader you want to be. So if you want to be making trades every, hour, you want to be studying an hour candle, and you want to just be predicting the next candle, whether it's going to be bullish or bearish. I don't want to be making 24 trades in a day, killing myself like that. So, you are going to analyze different time frames depending on what you want to do. In the altcoin markets across cryptocurrency, I try not to look at anything that has less than a daily candle, because then you're going to be looking at volatility. You're not really going to see confirmed structures, which, somehow, leads back to what you were saying about, the increased volatility. But, if you don't see these structures, you're not going to see confirmed trends. And if you're not seeing confirmed trends, you're going to trade them the wrong way and then eventually lose money instead of making money. So translating this into crypto now, this is an example of a fractal. So these are daily candles across Bitcoin. You can see how there might have been one, smaller bearish trend that was in there, but ultimately this is a pretty good replica of a segment here being replicated across time. Not across price, because they're occurring in different price zones, but either dilated or constricted based on the time period it was at. So you can see on both these examples a greater volume compared to the sell-off volume, and another pretty clear example of a trend reversal. This is pretty recent. This is up to just a few days ago. So we're like in the bearish trend that happened in crypto this past week. Sorry about going through a couple different kinds of charts, like different. This is Bitstamp. I think the other one was Bitfinex, but kind of readjust. So this chart is showing you a resistance after that trend reversal. So you can see this higher volume. This is zoomed in now. So we're looking at just here's 2018 going forward. So just analyzing this specific trend reversal, we have the higher volume. That is good to confirm that it could be a trend reversal. What you want to see now is possibly a structural pattern to confirm once again. Here is a possible inverse head and shoulders showing bullish. Head and shoulders are normally bearish. To continue, you have that peak as a head, and then that shoulder, which eventually leads to the bear market. Inverse head and shoulders is the opposite. So you're going to see a bottom as a head, and then you're going to see the shoulder lead to a bull market. That resistance line right there is going to, it looks in between 8,200 and 8,800, and that's what we call the neckline of the inverse head and shoulders. Once you break that, you know, you have a really good confirmation of a bull market, and you should be good to go. Depending on how risky of a trader you are, the volatility you're looking for, you know, when you're going to enter a trade like this. Some breakout traders want to look for the most confirmation. They're going to look to enter a trade when you break that final neckline resistance of 8,500. Other bottom seekers, knife catchers are going to try and get in on this head right here that happened around 6,300. If you can, it depends on how risky that, you know, you're trying to go, depending on where you want to get into a trade, how much confirmation you're going to look for. What's up? A knife catcher would be someone that looks at something that is completely bearish. So like if you see something like this, that is a large red candle, probably the biggest one, you know, in the recent past, that actually showed not great selling volume. So just by looking at the volume, you can kind of see that this is also what I was talking about last week was capitulation, which is where you see just a massive sell-off, people basically saying, okay, this is going to zero, no more hope. The fact that price showed that, volume didn't, is an indication of a trend reversal. So knife catching would be something where you look for the absolute bottom. You don't look for any kind of confirmation. You're looking to get in at the best possible point, but also the most risk. So that would be knife catching. Then what was the other word? Okay. If anyone else heard weird words, let me know. Okay, so the neckline at 8,200 would be, you know, the kind of confirmation point of, okay, we found the bottom. We're not going to go, you know, cry anymore. We're done. We're back on track to like 100K. So also going back to this chart, we can see that the resistance, this is a completely different chart from a completely different person, but they had the same resistance. After this head, they see, you know, they didn't call it an inverse head and shoulders, but they kind of show through supports and resistances that that kind of structure could appear. They have they drew a ABC, also known as like a 1-2-3 drive kind of formation, which is just continuation through the channel they drew, these blue lines. So if we can draw parallels between this chart, the other chart, the inverse head and shoulders, that key 8,200 mark is going to be, you know, whether we want to continue this bull trend, whether that was the bottom, or we have continued downward movement. This was a chart from like 10 minutes ago. So it's starting to reject 8,200. This move like right here is where we started to see downward movement again. So we don't know if the bottom's in. We got to see. You know, we got to wait for confirmation. The people that bought that bottom at like, it depended on the exchange where you were buying it, but I think it reached all the way down to like 5,800 maybe, depending where you were. But yeah, that might, you know, we got to see if it confirms, then we'll have a bottom and we'll be back on track. If not, we have to see. That's Bitcoin. This is from like 10 minutes ago. These are 4-hour candles. Each one of these candles encompasses 4 hours of trading. So high buying volume, right? Signal of bullish trend. And you can see how this, you know, this might look scary because it got rejected at the point where we were kind of saying it was going to get rejected, but there's not much volume behind, you know, this movement. Possibly more bullish than might not be. Yep. Say that one more time. How much does a little volume candle still have a big effect on a price? Is that what you're asking? I would say, well, there's a multitude of different reasons. The volume is going to identify a sentiment in a market, and it's going to kind of show you where the most people are leaning. But that's not going to necessarily tell you where the price is heading. So if you have, you know, some people who are really scared, they're going to dump the price. But the volume on that's not going to be high. So that's how you can have, you know, that uncertainty in a market could be a signal for a trend reversal, an explosion, a breakout of resistance, you know, something like that. So you got to watch the relationship between volume and price over time, and that's how you want to analyze your trends. Any more questions on Bitcoin? Really quick, I know we're running kind of short on time, but I have Ethereum too. This is the Ethereum channel that kind of, you know, the people on Twitter, the people on Reddit are trading, just the fluctuation between these two channels. And the scale on the right gets it goes up pretty fast, pretty quick. It might be cut off, but where the next touch of the red line would be around, people are saying between 0.5, 0.6 Bitcoin. I don't know about all that. I mean, with the regulation we saw yesterday at the meeting that happened that Noah was talking about a little bit, the ICO regulation could be teetering. We don't really know. There's a lot of uncertainty with Bitcoin or Ethereum right now. And you can see how at the middle of that channel, there's a dashed line running right through it. That's the median line. And we're starting to hit a little bit of resistance right there. Kind of scary for Ethereum, in my opinion. While some other people are just saying 0.6, here we come, you know, ICOs to the moon, whatever. Here's a fractal of Ethereum, kind of explaining more in depth why I think Ethereum, you know, why Ethereum could be headed for a bear market if it ends up getting rejected at that price channel. So now you can see how over time we've kind of repeated this process, although we're starting to see it condensed, how these blocks are starting to take up less time than these blocks. Or I'm sorry, the other way around. These blocks are going to start to take up less time than those blocks. This coiling price over time, how it's starting to become condensed, normally can signal a large output of volume at the end of this condensed price structure, and then a decision point's released, kind of, are we going up, are we going down? And I think that point is going to come soon because of some uncertainty with regulation in Ethereum, that kind of thing. So it's not that Ethereum, you know, is going to zero, it's going to crash. It's just the uncertainty in the market might be rising. The fact that that can contribute, you know, to higher price, lower price. We're probably going to move one way fast, whether it's up or down. So you just can't really be sure which way yet until we look for confirmation through a structure. These are just some funny charts too. I'm done. The inverse Stegosaurus.
That's all for this meeting. I'm going to stick around for a couple minutes. Talk with anybody if you want to stay and talk. But thank you for coming, everybody. Thanks. Yes.